What should my investment properties cash flow be in May 2022? Let's find out. Now, wee word of warning, this video could make some people angry, and the reason is us property investors are a passionate bunch, and we each have our own ideas about what an acceptable yield or cash flow is. Now, in today's video, I'm going to give you my view and the view of Opes partners, but hey, if you think that an acceptable cash flow is different or higher, or it's lower, that's cool too. We all have our own views. Now, let's talk about what a property's cash flow actually is. It is your rent minus your mortgage payments, minus any operating costs, your rates, your insurance, your maintenance, and any tax, and that gives you the cash flow either per week or per year. Now, this is the money that either comes in or goes out of your investment property's bank account each week/year. Now, I'm not going to go through the nuts and bolts of what to include or not include because we've already got a whole video on that. But if you've watched that, you'll see that cash flow really depends on a whole heap of things, and it's mainly strategy. So if you're investing passively, you're investing in new builds, the cash flow you're going to get is going to be much different than if you're actively renovating existing properties. And I'm going to go through both of these, but we're mainly going to focus on new builds since that's what we primarily know best here at Opes Partners. Now, if you've been investing in new builds before, you'll know that there are two main different types. You've got growth properties and you've got yield properties. Now, what's a growth property? It increases in value more quickly, but tends to have lower cash flow. Here's an example of one. This is a 4-bedroom, 2-bathroom townhouse in Glen Eden, Auckland. We've just had an investor purchase this for $999,000, and it's expected to rent for about $800 a week once built. Let's dive into our spreadsheet to see what the cash flow looks like. You can see from this, for the first 9 years, the property is expected to be negatively geared. Now, that means that the investor is going to have to put money into the rental property's bank account each week to top up that rental property. Now, why would it be particularly negatively geared at the start? Well, it's because we're projecting that interest rates are going to rise and those mortgage costs are going to increase. We're going from 4 to 5, projecting up to 5.25% before dropping back to about 4.5%. So the average for those first 8 or 9 years is about $158 per week that the investor would have to top up that rental property by. Now, if you want to download this spreadsheet for yourself, head down to the description. It's there 100% for free. You can download that. Now, you might be thinking, well, if this is meant to be an investment and I'm meant to make money off it, how does it make sense if I'm putting money in to top up that rental property per week? Well, that is a great question, and it primarily comes down to the capital growth over the long term, because the sort of investor who would purchase this sort of property would be somebody who's investing for that long-term capital growth. So here is our modeling based on the property increasing in value and also any cash flow that the property produces after it becomes positively geared compared to what the investor is putting into the property. And you can see from this that the returns from the capital growth and the future cash flow far outweigh what the investor is putting in terms of a top-up. Let's transition across and now talk about an example of a yield property. Now, yield properties, they grow in value more slowly, but tend to have higher cash flow. Let's give an example. This is a dual key or multi-income property in central Christchurch. This one is a bit different because it's got its own studio apartment on the bottom floor, and then the top 2 floors are another self-contained 2-bedroom townhouse. So you've got multiple income streams. One of our investors purchased this for $799,000 and it rents for $920 per week. Let's dig into that spreadsheet. From here you can see for the first 3 years it's expected to be negatively geared. The first year is because the property's under construction, it's not earning any rent, and then for the next 2 years we've got very high interest rates. After that it becomes positively geared. Those first 3 years, that's an average of $48 a week that the investor has to put in to top up that property. But again, we can see that the combination of capital growth and future cash flow from the property far outweigh those initial top-ups from the investor. Now, ultimately, your rental cash flow will depend on a whole heap of things. Your mortgage, your strategy, what you invest in, whole range of things. But I do want to take a moment to acknowledge a very valid alternative point of view, which is that cash flow should always be positive and that capital gains are just a bonus. Now, this sort of point of view tends to be held by people who are actively renovating properties and purchasing existing properties specifically to increase their cash flow. Now, this is a very, very valid point of view, but not everybody agrees with either point of view actually. In fact, 400 investors at the most recent New Zealand Property Investors Survey in 2022 said that they primarily invest for long-term capital growth, and just under half of that said they primarily invest for immediate cash flow creation. So about a third of property investors probably hold this point of view. And in fact, we don't think they are necessarily wrong, it's just a different approach. And in fact, we've got a whole service here at Opes Partners called Opes Accelerate, specifically trying to help these investors who hold this point of view to be really successful, renovate properties to increase cash flow. Now, if you are going to use this strategy, just a couple of things to keep in mind. You're going to be investing in existing properties, you're going to be actively renovating those properties, and you've just got to be prepared to pay that additional tax, because these sorts of properties are captured under the interest deductibility rules, so you do end up paying more tax. So what should the rental cash flow be for your properties? Well, of course it depends. But if you're investing in new builds in today's market, you probably want to allow somewhere between $50 and $200 a week to top up that rental property buy initially, just for those initial couple of years while it is negatively geared. Now, if you want to download that spreadsheet to run your own numbers, hey, head down to the description, click the link, download it for free, and while you're down there, hit the subscribe button and toggle that little bell just so you get notified about all our future videos.